Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, June 3rd. The week begins with not so encouraging trade news and mixed economic data from around the world. Oil and copper retreat. The US dollar is preparing to test its April lows, while the European defense stocks, gold miners, and the Swiss franc extend their rally on the back of rising global tensions. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the month of June started on a bearish note as the renewed trade tensions and mixed economic data from around the world set on the headlines. First, the tensions between the United States and China notched another level this weekend since last Friday, with both countries accusing each other of violation of the deal that they sealed in Geneva earlier last month and discriminatory measures. So it's no longer sure that Trump and Xi Jinping will meet to talk. Then not much progress has been made on the European front either, apart from the fact that the Europeans are upset, so much upset that the steel and aluminum tariffs were doubled to 50% effective from the middle of June. Remember, the deadline to United States and European Union trade negotiations is on July 9th, which is almost too early to be optimistic regarding a solution that will please everyone. Then, the tensions between the European Union and China are rising as well, as the European Union politicians want to, not to buy medical equipment from China, citing reciprocity of purchasing. So it's certain that if the Europeans also start playing by Donald Trump's rules, the next 4 years will be a nightmare, a global nightmare for everyone. But at least you would say everyone will get their share of this orange pie. I guess this is what global politicians are looking for at the moment, because I don't have any other explanation. Cherry on top, trade tensions are accompanied with military tensions, as you know, and the British Prime Minister announced yesterday at the government's strategic defense review that the government will spend £15 billion to bring Britain up to war fighting readiness. It is so scary, and it's needless to say that the European defense stocks were cheering the news at yesterday's trading session, with Babcock in the United Kingdom that makes submarines and warships rallying more than 8% just yesterday to a fresh all-time high level. Then select Stoxx Europe Aerospace and Defense ETF also added another 1.63%, reaching a fresh record high as well, while the rest of the Stoxx 600 index remained quite muted. Then gold rallied yesterday to a 3-week high on the back of renewed global and trade jitters, while the dollar franc sank below the 82 cents mark yesterday on the back of a flight towards safety, the safety of the Swiss economy that expanded 2% in the first quarter of this year due to a jump in exports toward the United States before tariffs hit, and that could actually be temporary. Now the Swiss inflation data will probably be out by the time I get this video published, and it will print the first negative read since April 2021, a read that could further boost expectation of a rate cut from the Swiss National Bank this month to 0%. Elsewhere, the latest PMI figures hinted at continued contraction in the German manufacturing activity in the month of May, but surprise improvements in French and Spanish manufacturing activities. Overall, the Eurozone manufacturing PMI surprised to the upside yesterday, while the ISM data across the pond hinted at a slowing activity in the United States. The latter didn't do much to fuel the Fed dose, unfortunately, as the US 2-year yield rebounded 4 basis points on Monday despite weak data, and the US dollar is now preparing to test the year-to-date lows last reached on April. Now, most investors are bearish on the US dollar, as we talked about it yesterday, and believe that the dollar's debasement will continue, and it will continue due to morose growth prospects for the US economy and inactive Fed to give support to the economy amid uncertainty uncertain inflation outlook for the US. As such, the euro-dollar consolidates gains above the 114 mark this morning, and the next natural target for the euro bull stands at 115.73 level, hit on April 21st, when the dollar index also hit its lowest mark this year. And the outlook for the euro against the US dollar remains positive on expectations that new target inflation in the eurozone will allow the European Central Bank to announce a comfortable 25 basis point cut this week, and probably another 25 basis point cut in summer. So euro traders will see confirmation of easing inflation in the eurozone this morning when the eurozone releases its flash CPI update for May. Now, across the channel, the rising inflation in Britain remains a headache for the Bank of England. And the Bank of England does, but many economists and many investors and many analysts out there are worried that the Bank of England has been left behind the curve, and that the budget measures from the British government present notable risk to British growth and demands closer attention in the coming months. In all cases, the US dollar weakness remains the major driver of cable toward the upside, which actually spiked above the 135 psychological mark again on Monday's trading session, and could extend its gains if the US dollar continues to weaken across the board, as it is broadly projected by analysts. Interestingly, though, the FTSE 100 index remains resilient to sterling's appreciation these days. The defense and gold miners there are doing pretty well, to say the least, in the face of geopolitical turmoil around the world. In the sense, Frenilo rose 6% at yesterday's trading session and is rising exponentially since the beginning of this year, since Donald Trump came to the White House. Elsewhere, in commodities, US crude closed above the 50-day moving average level for the first time since the 31st of March this year. But the unexpectedly weak Caixin manufacturing data from China this morning is somehow weighing on mood this morning in oil markets, while copper futures that are seen as an indicator, a barometer of global economic health, are also under pressure this morning on the back of that weak economic data from China, while VanEck's rare earth and strategic metals ETF remains at multi-year low levels, as the Chinese export restrictions toward the US as part of the trade war weighs on appetite and is a major frustration for Donald Trump's America, that actually needs these metals in their technology and couldn't get them if the trade tensions with China remain on the actual destruction path. Let's see what happens. I think that the prices are quite low right now. If there is a truce, it will be interesting to go there. In the US, however, the S&P 500 could shrug off the trade moodiness of yesterday, as steel and aluminum stocks actually rallied on news of extra tariffs on steel and aluminum, while the US big technology stocks remain in demand, and the big banks shared a report that Donald Trump administration is preparing to ease rules for big lenders. So this is something that we've been expecting, and it's materializing. So it looks like traders are either explicitly betting that Donald Trump will soften his tone on the trade front and on tariffs, and the 90-day post period will finally end better than expected with some deals. So that's now called the TACO trade, mind you. So it stands for Trump always chickens out, or investors are simply not factoring in the trade risk correctly due to a fear of missing out a further rally in the US stock markets. In both cases, the rally that we see today and gains remain on thin ice and risks persist. Investors will be watching the first pieces of the US jobs data due today, with the JOLTS job opening data, to understand how the US jobs market is performing through the Trump storm and how it is weathering what's happening in the US right now. Now, a final note for today: the Japanese 10-year auction today saw stronger than expected demand from investors, and the latter pulled the 10-year JGB yield below the 1.5% psychological mark, Notably, periods of increased demand for Japanese bonds have been accompanied by selling pressure in the S&P 500 since last summer, and that's largely due to the unwinding of what we call the Japanese carry trades, which send shockwaves through the global financial markets. As such, the relatively higher Japanese yields of today raise the risk of reverse carry trades and should be watched closely into the summer. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, on Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.